Well, the FOMC again showed its desire to get on with policy normalisation relatively quickly last week, with the first rate cut still most likely to come in June after the latest dot plot pointed once again to 75 basis points of easing as a median expectation this year, despite inflation forecasts nudging higher. Other central banks also took relatively dovish steps last week, with the BOE's hawkish dissenters moving back in line with consensus and the Swiss National Bank delivering the first G10 rate cut of the cycle. That supportive policy backdrop again gave risk assets the green light to continue moving higher, with equities scoring new all-time highs across the globe, while the dollar also gained ground, with there still being little beating the buck on either growth or yield. A quieter week awaits the financial markets this week, with Easter looming large this weekend and the US PCE figures on Friday, this week's main event. Plenty for myself and Ryan Littlestone to discuss on the trade-off this week. Without further ado, let's get into the show. So, as expected, it was a busy week for the financial markets last week, with a deluge of central bank decisions, all making relatively dovish overtures on the whole, although, of course, the BOJ taking their first steps towards normalisation as they came out of negative rates. I think Ryan will be glad of a quieter week this week. Ryan Littlestone from Forex Flow Live and Forex Analytics joining me, as always, to discuss everything that's going on at the moment.
Morning, Michael. Yeah, a little bit quieter, perhaps. Don't want it too quiet because we need a bit of volatility to trade. But that was really a one-off week last week. Well, it's been a busy couple of weeks, but we're over that hump now, and hopefully things will settle down, and we'll see what's to come.
Yes, definitely. Of course, month and quarter end in the mix this week. Today, obviously, being corporate month end value date in the FX market. But by and large, I think we could be in for a relatively subdued couple of weeks. Obviously, the PCE figures on Friday, which we'll get into. But really, the next US jobs report on the 5th of April is I think, the next key risk for markets at the moment, isn't it?
Yeah, very much so. We've got a bit of data out, which we're going to highlight this on this show. And like you say, we've got the jobs week next week, and the data steps up again. And we play the same old game. The market has its thing going into a Fed meeting, has its thing going over a Fed meeting, calms down, and then we start it all up again into the next Fed meeting and all the other central banks. So, yeah, it's the same old cycle, and we love it.
We do indeed. And as you mentioned, all those central banks, that is a lovely segue to take us into Topical Thunder and work out exactly what they all said last week. So that is precisely where I want to kick things off this morning, with that deluge of central bank meetings that we had over the last 4 or 5 trading days. Now, Ryan, of course, covered the Bank of Japan in last week's show as they scrapped negative rates and yield curve control and ETF purchases and a lot of other things besides. But I think other G10 central bank decisions last week were equally as interesting, as pretty much every major policy body that we heard from took dovish steps as they either cut rates or signaled that rate cuts are coming in the early part of the summer. Now, I mentioned the Fed in the introduction to the show, of course, maintaining the target range for the Fed funds rate at 5.25% to 5.5%. The policy statement, pretty much a copy and paste job from January, saying again that the committee is seeking greater confidence that inflation is returning towards 2% before delivering that first cut. But what I think was really interesting, actually, from the FOMC was it's pretty clear to me that they are quite desperate to cut rates, and they're quite desperate to get on with policy normalization in a relatively rapid fashion at this point. And what tells me that is 2 things from the latest summary of economic projections. The 2024 median dot continuing to point to 3 rate cuts, 75 basis points of easing this year, coupled with this year's core PCE forecast, which is the Fed's preferred inflation gauge, being nudged higher to 2.6% from 2.4% previously. So that is a relatively dovish message from the Fed. I think also Powell claiming that he's not reading too much into the noisy January and February inflation prints. That certainly leaves a June cut as the most likely scenario for me. And that dovish stance was really mirrored by everyone else that we heard from last week. The Bank of England leaving bank rate unchanged at 5.25%, 5.25%. But Haskell and Mann, who had voted for a 25 basis point hike back in February, moving to vote for unchanged. So a dovish step there. And then Governor Bailey saying to the FT the following day that rate cuts are now on the table and that inflation is moving in the right direction. Again, I think June is most likely for the BOE to deliver that first rate cut. And then again, other G10 central banks saying the same thing. The RBA keeping rates unchanged, ditching the tightening bias from their statement. The Norges Bank keeping rates unchanged, but flagging that they see gradual rate cuts from the autumn onwards. But you'd expect that that timeline may end up being brought forward a little bit. And then, of course, you had the Swiss National Bank, which to the market came as a surprise. But Ryan and I, we called this on the show last week. So we'll give ourselves a little metaphorical pat on the back for this one. The Swiss National Bank actually delivering a 25 basis point cut last week, becoming the first G10 central bank to cut rates this cycle as inflation settles back towards the bottom of the SNB's target band. So a lot to get our teeth into there. I guess, Ryan, what was your sort of key takeaway from that big mix of policy decisions that we had over the last 4 or 5 days?
I could probably do a show all on our own.
Well, we could, but we shan't.
Yeah, you missed out Mexico cutting rates by 25 pips as well. So that sealed the deal for the central bank week. I've got a slightly different opinion on the Fed. It's a difficult one. I don't think there was anything more dovish in that. I think it was quite bullish. The GDP forecast moving up, the PCE forecast moving up, unemployment forecast going down, so looking better. So it looked a bit more bullish in the forecasts. Not that made Powell hawkish at all, but it just reinforced for me the higher for longer message, which was non-dovish, if you like. I think they are scared. I won't swear, they are poo scared about inflation coming and biting them. And Powell actually mentioned that in the press conference when he said that inflation CPI number hadn't fallen for 9 months. It'd been sticky, and that's something that I've been showing for quite some time. We came down, I think it was June, July last year, so saw that 3% mark. CPI hasn't gone lower than that since, and that's what's getting them really worried. They want to cut, yes, desperately they want to cut, but they are really scared that they may not have to cut. And I think the other take from the Fed also was those longer run dots moving up. Not as much as maybe we expected or thought, but it's slowly moving up that neutral rate or the expected neutral rate. So that's important for the future because that will determine potentially how far rates will come down. We're saying 3 cuts at the moment, or the Fed's saying 3 cuts at the moment. Probably maybe only another 3 cuts after that if they want to get to that sort of neutral rate. But 3.5%, 4.5%, that's not too far to go. So we need to keep an eye on that moving forward. As for the rest, Bank of England, I thought it was again not really dovish. Those hawks moving over to the neutral side, but it was a little less hawkish, shall we say, for those guys. Just a question now for the BOE whether we start to see 1 or 2 now moving to the cut side, joining Dingra on that cut vote. As for the timing, I still think it's going to be past June. I think August is probably still in the frame for me for the BOE. They're going to be slower. Again, with inflation's coming down as fast as they want it to come down, but wages are still sticky. And I expect us to see something a bit like we have in the US, where inflation comes down and then maybe just starts to go sideways a bit and settle at a level. So we need to keep an eye out for that. But the market moving around its rate expectations is what gives us the volatility to trade. So the market's going to do its own thing.
Indeed, you are absolutely spot on. And as you said, we could talk about central bank decisions all day, but this show would actually become quite boring if we did, and we got into the weeds of, neutral rates and R-star and all the rest of it. So we shan't. And what we will do is we will move on, because I know you want to give us a little bit of a cross-check on the economic situation. Blimey, I need another coffee.
Easy for you to say, yeah. And,
yeah, exactly.
Because, we need to look at what's happening in economies, obviously, to get a possible future path for rates. So we've got over this central bank hurdle. We're back to data watching like the central banks are. So it's important we have a bit of a handle on the underlying economic conditions. Last week's PMIs didn't really offer anything new, save for the fact that in pretty much all of them, every country, price pressures remain elevated, some of which are gaining still. So that may add to the sticky inflation numbers we've seen in the US and elsewhere. Now, while we've continued to see inflation dropping in places like the UK, there are worries that it doesn't complete the job in getting to target, and like the US, could settle somewhere above target for many months. But then on the flip side, that's obviously something Japan's hoping for. They want inflation above target significantly. So really, the latest school report card sort of reads thus, that the US is still the class swap, with growth still holding up. Europe must try harder. The UK must concentrate more if it wants to raise its grades a bit higher. Japan has shown great improvement since last term and needs to keep up the good work. China keeps being off sick and shows no sign of returning to class anytime soon. So overall, unless these things change markedly better for good or for worse, countries are going to be ticking along at current growth levels, and that's going to keep market sentiment for central banks pretty where they are at the moment. So I'm going to ask you, Michael, what's your report card say when you were at school?
Yeah, that's freaking, because I was literally about to ask you the same question. Yeah, naturally, I was akin to the United States. What else would you expect, mate? I think for me though, the key message from all of that, which there is I do love the analogy, by the way, and there obviously is a serious point to it. I think the key message is that US exceptionalism remains firmly intact, not just in terms of the data that's coming in from the PMI surveys and everything else, but also if you look at, and I know we love to ridicule sell-side forecasts on this show, but if you look at the consensus expectations for US GDP growth this year, they just continue to be revised higher at this point. I think 2024 GDP consensus is now at something like 2.1, 2.2%, which is as near as makes no difference double what consensus expects for any other developed economy over the course of the year ahead. I'm throwing China out there because their data is just nonsense, let's be honest. And actually, for other economies, you see those consensus expectations being revised lower. And I think really in the sort of medium term, that should continue to support the dollar, because obviously the market is going to buy into that growth story. The market is also going to buy into the net result of that, which is the likelihood that the Fed not only maintains tighter policy for perhaps longer than peers, but also loosens or normalizes policy to much lesser degree than you're likely to see from the BOE or the ECB or other G10 central banks. So it's an interesting time for sure. But I think the key message from all of the data at the moment is US exceptionalism is still here, and it's not going away anytime soon, I don't think.
Yeah, very much so. And obviously my good colleague Blake, he's been far more bullish on the US. He's getting to the point where he thinks they may not even cut this year. I think, like we said, I think they are desperate to cut. They need to get rates down, or the higher they are for longer, the more damage it potentially is going to do. But I think it is a real risk that they maybe don't cut as much as even they expect, and that's going to send a few ripples through the market as well.
Yeah, it is a significant risk. I was actually looking at this yesterday, and I'm going to get the number wrong now, but I did write this in a note that's on the website somewhere. At the December meeting, I think there were 5 policymakers who had their dot below the median. So basically saying they expect to cut rates by more than 75 basis points this year. At the March meeting, so the dots that we got last week, it was just 1 that was below the median. So even on the FOMC, that dispersion is moving, and that balance of risks is moving in much more of a hawkish direction than it was before. I still think they cut, because what's going to be on policymakers' minds is they're within touching distance of a soft landing and inflation is within inches of target. Do you sacrifice that soft landing just to get another 20 basis points lower on headline CPI? Probably not. But I think the balance of risks, particularly if we get another couple of months of relatively sticky inflation figures, particularly on the services side, that balance of risks does begin to tilt much more towards cuts later in the summer. And then, of course, the other complicating factor that comes in is the election in November. So you then say, if the Fed aren't in an easing cycle by, election campaigning really kicks off on Labor Day. If the Fed aren't in an easing cycle by then, do rate cuts become a political story? I'm sure that's one we'll get into later in the year.
Yeah, very much so. And, we've had this market expectation where it was far too dovish coming into this year. 4 or 5 cuts it was expecting, and then we get to last week's Fed, and a lot of the market expecting only 2 cuts. So the pendulum keeps swinging, between what the market thinks, and it's going to create some interesting trades coming up.
Yeah, absolutely. I love how we said we're not going to do the whole show on central banks, and we've gone straight back to that topic. So let's try and get away from it. Let's try and get away from it, because it is a little bit of a quieter week coming up for the financial markets this week, as I alluded to in the introduction to the show. And actually next week is relatively quiet as well, although we do get a smattering of PMI surveys. Of course, we've got Easter in the mix as well, with most markets closed on Good Friday. FX will be open, a handful of Asian equity markets will be open, but European and US markets will naturally be closed on Good Friday, and then UK and European markets will be closed on Easter Monday as well. So that will naturally sap volumes and liquidity from the market. So if you are trading over the Easter period, then please do be a little bit more careful and perhaps a little bit more aware than normal. And actually, if you are trading, then I would say don't go and take some time away from the desk. Rest is just as important as it is to be at the screens, because after Easter, things are going to hot up pretty quickly. But back to the here and now, the data calendar is very, very light indeed this week. We've got the PCE figures due on Friday. I would love to know who in the United States is doing this, because last year on Good Friday, we had a jobs report. This year on Good Friday, we have the PCE data. Can you guys just give us a day off, please? I think we would all really appreciate it at this point. But on a more serious note, we are expecting course PCE on a year-on-year basis to remain unchanged at 2.8%. The month-on-month figure will cool a touch, we expect, to 0.3 from 0.4% prior. I think the upside risks associated with the PCE data are a lot lower than what we saw with CPI and PPI. There's 2 reasons for that. One, because if you have CPI and PPI, you can have a pretty decent stab at what PCE is going to be. Sorry for throwing all these acronyms around here. And the other is that the big factor that boosted CPI to the upside was shelter and rent costs, and that has about half the weight in the PCE basket as it does in the CPI basket. So I think we are much more likely to be somewhere in line with consensus on this data. But beyond the PCE figures, I think markets are really going to start to look a couple of weeks ahead. The next big risk events for financial markets come firstly on the 5th of April with the next US jobs report, and we're expecting, I would assume, another solid payrolls figure there, although we'll keep a close eye on unemployment, which did unexpectedly rise in the month of February. And then after that, the 10th of April, we get the next US CPI figures. Obviously, that will be referencing March, whereas the PCE that we get this week references February. And then we roll on into earnings season, which starts on Friday, the 12th of April, with JP Morgan, Citi and Wells Fargo all reporting. And then we roll into the financials, and then things really pick up from there. So I think in the meantime, you've got to say, what do markets do? Well, if there's very little data flow and relatively little news flow, then you would expect markets to take what I would term the path of least resistance. Although Kyriakos wishes I didn't term it that, because it doesn't quite fit in his thing on the right there. And for me, that path at the moment is equities higher, dollar higher. And unless we get a catalyst to derail either of those trends, I think that is where markets are most likely to go over the next couple of weeks until that jobs report on the 5th of April.
Yeah, I think so too. That PCE is going to be quite important. And to go back to central banks again, that's going to be my marker for when they're going to look at cutting. I think if we see core PCE 2.5% or less, that's their trigger then to give a firmer idea of when they're going to cut over in the US. But as for the rest, we should note that US bond markets will be closing early on the Thursday as well. So it's a half day for those guys on the Thursday. So liquidity is really going to drop out. And these Easter periods can be a bit funny. I've seen times when usually it's just quiet and it's just dead, and we're just ranging 10, 15 pips, across the course of the day. But then, when you get that lower liquidity, if something pops up, a headline or a bit of news, data point like this, it can catch the market on the hop, and we see a bit more of a volatile move just because there's not that much liquidity in the market. So it's a bit of a funny time. I echo your sentiments. It's a good time to have a little refresh in the early part of the year, and then we go straight back to battle that week as we run into the jobs market.
Indeed, yes. I think that's a very, very good point, actually. And obviously, with all the geopolitical risk that continues to linger, those unexpected headlines could pop up at any time. And as you say, if one of those drops into a market where everyone's got their feet up on the sofa and there's very, very thin liquidity, you could see some pretty sharp moves. So do, of course, be aware of that if you are running positions over the Easter weekend. Right, let's move on. Ryan, there's an old phrase in markets: never bet against the US consumer. Does that still ring true?
Possibly. It's something we've been keeping an eye on. Sorry?
I said, come on, get off the fence.
No, it's nice and comfy here. Now, as Michael mentioned, there's not a lot of data out this week, but there's 3 items I will be watching pretty closely. I've spoken previously about seeing some weakening consumer-related data, and we have some of those data points to watch this week. The first 2 are actually today, so hopefully you'll get this recording before those drop. That's a durable goods report and the Conference Board consumer confidence numbers. Now, the durable report can be a bit messy as there's many components to it, and outside of the headline number, I'll be looking at the more consumer-oriented components like electrical equipment and appliances, computers, electronic products. These make up a sizable chunk of consumer purchases, but are also at the higher priced and sort of more discretionary end of the purchasing scale. People don't buy fridges every day, but if those purse strings are being tightened, that old fridge that needs replacing might have to last a little while longer. Then we have the Conference Board consumer numbers, and later in the week, the final Michigan numbers. Now, last month, the Consumer Board data took a bit of a dive from around about 115 to sort of 106.7. That prior month was also revised down from 115 to 111, we'll call it. That's one part. And the other part is obviously those inflation expectations, which stayed sticky on the 1 year at 5.2%. Now, much like the Conference Board data, the Michigan saw a decent rally into year end, but it's been bleeding lower ever since. So for me, the worries about the consumer are still there. We'll see if that bleeding was just maybe a washout from the holiday period, or whether it's showing signs of a real downtrend developing. We've spoken previously about the autos market, the EV market, that might be heading for a bit of a slump. So we've had a couple of data points over the last month or so that just got me raising my eyebrows, shall we say. And if we get this data this week coming in softer as well, not that it can go much higher, but my eyebrow might go slightly higher, and we might be getting some warning flags starting to wave. So the consumer is going to be important this week, and that's the main thing I'll be looking for.
Yes, indeed. Your comment on EVs reminded me. My EV's on my desk in there. I should have brought it in. I forgot. Yes, I think the data is going to be interesting, but I'm preparing an absolutely humongous bucket of salt with which I'm going to take all of the data. And the reason for that is, as you said, the durable goods orders number can be and is quite messy. I mean, to be honest with you, the headline durables figure is basically just a proxy for whatever aircraft have been ordered from Boeing in that month. So you do really need to look at those core components, excluding transport, excluding aircraft, excluding defence, to try and get a clearer picture of exactly what's going on. And then the other caveat that I would make is just on those consumer confidence and Michigan sentiment figures. And I don't want to go down a bit of a political rabbit hole here, but the surveys do appear to have become quite politicised over the last 4 or 5 years, particularly the Michigan data. They actually publish sentiment for Democrat, Republican and independent. And if you pull that up on a chart, which I naturally don't have to hand, there is a very, very close correlation between the sentiment of the appropriate political party and which colour president, in terms of Democrat or Republican, which president holds office at any one time. And I think that's only going to get worse and distort the data even more as we move into election season. So yeah, the figures are going to be interesting, but I personally would perhaps be loath to put too much weight on them. And going back to earnings season, I think one of the best reads that we get on the consumer, apart from retail sales, is going to be earnings from the likes of Walmart, Home Depot, Target. They are the ones that I would really be watching as a sort of bellwether on how consumer spending is progressing.
Yeah, I can't disagree with that. It's not. I don't think any of it's going to be real market moving data, but I like to look at the longer term. So if I get these little signals popping up in certain data points, it all sort of fills in pieces of the puzzle for me, and it gets me then thinking about trades ahead of what maybe some other people will expect or they'll see from this data. So it's all about just catching those early trends. If you can get in those trends early, that's when you get the nice big moves.
Indeed, you're absolutely right. It all helps build a picture of exactly what's going on. And, I would actually say the same for central bank speeches. We've got a lot of central bank speakers this week, Fed's Waller and also Powell speaking on Friday. This data, these central bank speeches, they may not move the market in the here and now, but it is absolutely pivotal to pay close attention and go through the releases with a fine-tooth comb, go through the speeches forensically to build up a broad picture of exactly what's going on. And as you say, perhaps spot things that others haven't spotted and exploit those opportunities before the market perhaps starts to run away with itself when those flash up as a Bloomberg red headline in a couple of days' time. And, that is what the game is all about. In any case, let's get on to some charts in That's a Setup. Okay, so a bit of a sense of deja vu here, because I think we're both kicking off with our plays of the day from last week. Mine was obviously the Euro Swissy, and actually that worked pretty well over the Swiss National Bank, as you can see on the chart there, with Thomas Jordan and co. surprising markets with a 25 basis point cut. The OAS curve had only priced about a 1 in 3 chance of such a move before the meeting, which is why we saw such a violent move lower in the Swiss franc. That sent Euro Swissy north of my target, which had been just shy of the 97 figure, and actually took spot to its highest level since July of 2023. But I think this is a good example of where I don't particularly want to get too greedy with this trade. Levels of volatility in the FX space outside of the yen remain relatively low, although we'll get onto that a little bit more in a second. And actually, the other thing is, if you go through, as I was just alluding to, the press releases and the press conference that came from the Swiss National Bank, they didn't really give us any firm guidance as to what they're going to do next. They didn't seem in a particular hurry to send a really aggressive, dovish message or to signal that further rate cuts are coming, even though they are most likely, and the market price is about 50 basis points more easing this year. I think it's just a case of the theory worked. It was a short-term trade over the Swiss National Bank. It moved in my favor. Not going to chase this higher just yet. We will see how this pans out, and of course how the ECB side of the equation pans out as well. But for now, it's time to move on from this one for me.
Yeah, sensible maybe. I'm never one for giving up a winning trade. That's just my sentiment, the way I look at it. And so, for other people who may have been trading this one as well, you've had a good move. You should be in good margin with this one. You can just rely on the levels. Your chart there, that 96, 85, 97 level. That's really the pain level from here. If we're back below there, then that's the market saying, we've traded out the SMB. We've had our move in the Swiss. Maybe now things are over and we're going to consolidate a while. So the way you can do that, if you've got that margin, that's where you can bring your stops up below to just below that level. And then that allows you just to sit in the trade, see if we get another move towards the highs. What happens at those highs? Do we make a new high, or do we hold just below? And each of those signals just can help you extend a trade, if you like. It doesn't mean you have to rush to exit. Take partial profits off, leave just a little bit on if you need to, just to see if you get that extra move. You can just, the icing on the cake for the trade. But otherwise, we've had the move. It's made a high. That's the target now for anything further from this point onwards.
Yes, indeed. Right. Let's move on to your play of the day last week.
Yeah, my play of the day. This was US 10-year Treasury yields. Last week, I was looking at this now as more of an indicator for the dollar moving forward in the short term, while markets sort of still digest what the Fed are doing and then start to price up the next meeting and the amount of cuts or not. Now, in the end, we didn't manage to push those yields higher over the Fed, but we did drop back to the pivotal 4.2% mark. Now, although looking at it, we did have a little dip below, but we failed to close below that 420 level. Since then, we bounced. This 420 is going to be a real decider for the dollar. And, whether pairs like euro dollar, Aussie dollar are going to hold or break their key support levels. So far, the bouncing tens looks pretty dead cattish. And as has, yesterday, the bouncing euro dollar looked the same as well after testing the 108 support. So we're not out of the woods yet. I imagine we're going to probably enter a bit of a consolidation phase until we start getting the big data rolling in next week. But we can still use yields this week just to trade intraday and trade some of the ranges. So, for example, if 10s really go sub 420, it's looking like a proper break. Maybe we go down to 410 or around the March lows at 4.04%. Then, as one example, I expect something like euro dollar to be up pushing 109 again. So that's how you can use yields as your indicator for what's happening in the dollar and certain pairs. But make sure you also add 2-year yields to your watch list as they remain largely unchanged post-Fed. And they are staying at levels consistent with 3 cuts. So it's a good indicator to look at market expectations for the amount of cuts that the market sees at the moment. It's in that 3-cut range. So if you see yields coming down, that's going to suggest that the market is changing its view of expectations. Same on the upside if yields are going up. So yields, as we always say here, they're always a good watch for the dollar, and particularly pertinent this week if things are a little bit quieter. The market's going to follow those yields around.
Absolutely. You're spot on. I think the Treasury market is by far the most important market for any trader to be watching, because it is obviously a key input into where foreign exchange goes, but also where equities trade and all the rest of it. I actually take a little bit of a different view here. I think one of my, and this is a very big picture, long-term view, by the way, so we'll come back to this in Q3 or whatever. One of my big takeaways from the Fed last week was they're not fixated on the explicit, outright, specific 2% inflation figure anymore. All of the language is we want confidence that inflation is moving towards 2%, not that inflation prints at 2%. And if you look at the forecasts, they actually don't see either PCE, headline, or core getting back to 2% until 2026. So what I see happening with the Fed now is they are pretty desperate to cut and normalize, as we alluded to. I think they'll be relatively happy to target almost an inflation range of kind of 2 to 3% without explicitly having their mandate changed. That is just how they will interpret it. And if they were to do so with inflation expectations remaining relatively well anchored, both market-based and consumer expectations, as Ryan alluded to earlier, if we were to move into that regime where the Fed target, 2% inflation almost becomes a floor rather than a ceiling, as it was pre-financial crisis, what you would expect is the long end to sell off, long end yields to move higher, and the curve to steepen. So that would be where my long-term bias remains. But Ryan, as you rightly said, I think in the short term, watching the Treasury market is absolutely key over the next couple of weeks as that data flow quietens down a little bit. Yeah,
exactly. And I've got some thoughts for the future. I would not be surprised if once inflation comes down, like you say, in that 2 to 3% range, rates are down at neutral levels, most of these central banks are going to move from a target to a range, a bit like the BOC and others. They've been speaking about changing their mandates and how they view inflation. I think once things settle, they'll do just that.
Indeed. Have you been speaking to our good friend Richard Matthews by any chance? Because he WhatsApped me exactly that line at about 5 o'clock last night. So I'm now starting to think he's feeding you tips for the show.
Well, what they say, great minds think alike.
Yeah, they also say fools seldom differ, but I like you both, so we won't go there, and we will move on to the FX market, because I mentioned a moment ago that we saw signs of volatility rising a little bit last week, and as you can see here with JP Morgan's very helpful G7 FX vol index, we have risen to about a 6-week high in terms of implied volatility. Now, I would just say we do need a little bit of caution here, because if you look at that chart, you go, oh, wow, the FX market's alive again. Great, let's pile in. I wouldn't be doing that if I were you. And the reason why is because this index has about a 25% weighting towards the yen if you go into the methodology of it. And of course, we saw a big move in dollar yen last week, and markets now a little bit worried about intervention once more as we approach the 152 figure. So you do need to bear in mind that the index will be skewed a little bit. But I do think that last week gave us some signs that volatility in the FX market is starting to come back. And that's not only based on what we saw in the option space, as you can see here, but also in terms of the hints that we got in terms of what's likely to come around the idea of central bank policy divergence and yield divergence, which will naturally, you would expect, begin to breathe some life into the FX space. Now, if you think about the developments that we had over the last week, you had the BOJ raising rates by 10 basis points. Yes, it's 10 basis points, but it's still the opposite direction of travel to that being taken by other central banks. You also saw hikes in Turkey and Taiwan as well for the emerging market watchers. Meanwhile, you had the Fed striking a relatively more dovish tone, still seeking confidence that inflation's on its way back to 2%. But of course, the risks are that that's stickier and that cuts are delayed. And in the meantime, you had another really dovish slate of ECB speakers. The doves really do seem to have been released over in Frankfurt at the moment, although June still seems the most likely time for that first rate cut. And then, of course, speaking of cuts, you had the Swiss National Bank delivering a cut of 25 basis points and becoming the first G10 central bank to ease. So I think what this all points to is that although Japan excluded, the direction of travel is one of policy normalization. That's going to happen at differing speeds, and that's going to happen at differing magnitudes. And as a result, that should hopefully breathe some life back into the FX market. And it leaves you with a situation where lower yielders, such as the Swissy and the yen, are likely to be sold and actually perhaps used as funders. And you then end up being long the currencies where rates are likely to be held higher for longer. And with that still being the overarching theme, you guessed it, I would remain bullish on the dollar. Ryan, what are your thoughts on whether the FX market is starting to perhaps come alive again?
Yeah, I think this is one of context. I mean, as you can see, that chart, it's picked up in that period you've circled there. But if you look at the wider picture, vols are gradually coming down. There's a definite slant down in that chart. And that's natural when you come out of big events. You know, we came out the COVID thing, we came out the GFC. You know, volatility naturally drops, and I'm always looking at volatility because it's a good gauge as how markets are going to move intraday. Yesterday, vols are pretty low again. You know, we saw 20, 30 pip moves in pairs. I think we've got to expect that a little bit, but the volatility is going to come in waves. Last week was a big volatility week, so much going on. It's natural for volatility to be higher. Yes, the yen as well, that's going to retain a lot of its volatility because we don't know what's happening for the future of the BOJ. We don't know what's happening with this 152 intervention, all the like. It's going to keep vol there. I do think we're going to continue to see volatility pick up, but I think it's going to be in waves. So this week is probably going to be a pretty low volatility week, and then we'll pick up next week into the jobs report, and then such as we get to all the other big data points, and then again into the central bank meeting. So, yeah, volatility is what we want to trade, but you also have to learn how to adjust to volatility with your trading strategies. It's okay having a high volatility situation, plenty of moves, plenty of pips, but if you do see volatility dropping off, you have to know how to adjust to that, because your 40, 50 pip moves last week may only be 10, 20, 30 pip moves this week. And you have to adjust that to your trading. You can't get over expectant. And as I point out on here, sometimes I watch the 1 month at the money FX vols. Gives you a good idea of whether things are picking up or things are slowing down a bit.
Indeed, yes. And I think that's a great point around being nimble and agile and changing your trading strategy and your plan dependent on prevailing market conditions. That is absolutely pivotal to be in this game for the long run. Sticking with the FX market, I see you want to talk about the euro.
Yeah, we're a bit Euro focused today, I've noted.
We are. It's very, very unusual.
When it comes to you hate with a passion, we're talking about it quite a lot at the moment, but that's the way it is in markets, isn't it? It's there to be traded, so we might as well trade it.
Exactly.
I'm talking about euro dollar, and sometimes when we have big events like this, it's important, just as important for me to see where prices finish as what they do during all the events. Euro dollar, we've been in an uptrend since late last year, and we keep confirming that pattern as well. Fibs are an important tool for measuring trends for me, and as you can see here, give or take a few pips, we held the 61.8 fib of the October-December rally. That's the white fib on the chart. And now we've held the 61.8 fib of the Feb-March rally following last week's big events. That's the blue fib you can see in the chart there. Now, that tells me that the uptrend is still valid as we're holding what are sort of my fib last lines in the sand, if you like. Now, I also try to be objective when looking at the charts, and the biggest risk to the wider trend is the fact that the bounce from the October-December 61.8 ran out of steam in the 109 area, which was the high, coincidentally, at 109.70, round about the 61.8 of the DEC Feb drop, which we broke only briefly over the last NFP report. That's the orange fib you can see there. So what does it all mean? I've got loads of fibs on there, but what does it really mean? It means that the 108, 107.90 is the main support here, which we're holding. But to maintain the wider uptrend, we need to get back above 109, take out the prior 109 highs. We can probably call it 110 as that level is the one that really needs breaking. So a move down through 108 or above 110 would likely mean something has changed. So in the meantime, it's a pretty decent range to trade if we're going to consolidate for the time being. And you can take your clues if we break either side of that range.
Absolutely. That's a very good summation. And of course, it reminds me of that bet that we had. What was it, 105 or 111, 112 next?
I think it was 111, yeah. I could steal 100 pips and say it was 110, but no.
It definitely wasn't 111. But indeed, as you are correct, we are in that relatively well-defined range. It is a nice range to trade for the day traders. While we are in it, it is very well-defined, as we said. And for the longer-term traders out there, it's a case of watching and waiting and playing those levels even when they do eventually break.
Yeah, very much so. And if you're an Elliott wave aficionado, there's probably something in there for you. There's a decent couple of waves I can see there. I'll have to get my guy Gregor on the case.
Elliott waves, dearie me. Fibonacci was bad enough. You're raising my blood pressure this morning, Ryan.
We'll get you there, mate. We will get you there next time. Give it a few more months. Your charts will look like the London Underground map as well.
Oh, if there's ever an Elliott wave on one of my charts, then do please interpret it as a cry for help. In any case, let's move on to our Elliott wave free plays of the day. I'll just start using like lunar cycles instead or something. They're probably both as reliable as each other. Right, I want to look at Euro Sterling this week. As you said, it is a very Euro heavy show. And actually, speaking of cries for help, this isn't one, but I'm actually starting to like being long Euro Sterling, which feels very odd for me. I know, I'm jumping on your bandwagon.
When was it you accused me of stealing your thunder a couple of weeks ago? And here we are. Now he's nabbing my trades after the event. Go on, you carry on, mate.
What was it you said earlier? Great minds and all that, And the reason why...
What was it you said in response?
Yeah, let's not go there. The reason why I'm somewhat stealing your idea from last week is because of two things. One is that Euro Sterling has not only held that bounce off the 85 figure, but also moved north of the 50-day moving average. But the other reason is that if you look at the yield spread between 2-year bunds and 2-year gilts, that has moved further in favour of the euro over the last week or so. And actually, as you can see from that relatively crude overlay on the bottom of the chart there, that yield spread suggests we should be trading much closer towards the top of the recent range, which is around the 87 figure, than it does towards the middle of the range, which is where spot currently trades. So I would be happy to take a long at market here with a stop below the 85 figure and targeting just shy of the 87 figure to the upside. Though obviously we do need to get through what could be relatively stiff resistance around 86.60 with those 100 and 200 day moving averages in the mix. But if we, the 86 figure. But if we do get through there, then upside could prevail in relatively short order. Ryan, the FTSE 100.
Yeah, the FTSE 100. It's finally starting to move. So I've got a pretty simple play of the day here. The FTSE doesn't seem to last long, or hasn't seemed to last long every time it's been up at 8K. So I'm looking to short another move there. I'll keep a tight stop just above the prior sort of 80, 40 area, 44 highs. And if shorts are triggered, I'll employ my usual slice and dice strategy, roughly taking profit every sort of 20, 30 ticks it goes down. hopefully if it goes my way, while also pulling the stop down behind it to reduce the risk. So a simple one here, tapping the big figure in the FTSE.
Good stuff. Oh, the FTSE 100 is bloody torture watching that thing, isn't it? It hasn't moved for years. Purely for the sake of my pension, I hope we do manage to blast through the 8K figure and hopefully join in with this risk rally that's taking place elsewhere. But my hopes for that are sadly relatively low. In any case, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me, as always. Thank you very much as well to our producer, Kyriakos, for bringing this together as brilliantly as he always does. All three of us will be back with another episode of The Trade-Off this time next week. In the meantime, hope you've enjoyed the show. If you have, drop a like on the video, leave a comment as well. Let us know your thoughts and how you're viewing the markets at the moment. And all three of us will be back again this time next week. Thanks as always, and goodbye.